Now, before we get to the charts, time to take a quick look at what traders are watching. US central bank officials are raising new inflation concerns, and staff suggesting the incoming Trump administration's plans may slow economic growth and raise unemployment. US President-elect Donald Trump is considering declaring a national economic emergency to provide legal justification for a series of universal tariffs on allies and adversaries, CNN has reported. US weekly jobless claims are at an 11-month low that points towards a steadily cooling labour market, which could allow the Federal Reserve to keep interest rates unchanged in January against the backdrop of still high inflation. Analysts have lowered their fourth quarter earning estimates for ExxonMobil the day after the top US oil producer warned that reduced prices and margins could hurt quarterly results. Now, the benchmark Brent crude oil futures market reached its widest since August 2024, reflecting concerns about tightening supply and expectations of a revival in Chinese demand. Now, Peter Pan from ACY Securities joins us now. Thanks so much for joining us, Peter. So what are we looking at today?
So the AI booming has great for big tech companies. But if we look at the market as a whole, most non-tech companies has taken a hit during the previous months. It is like the big companies has sucking up all the hot monies in the market. And now everyone is focusing on whether AI can actually deliver real profits. Let's take Nvidia, for example. After launching new products at CES, its stock price dropped. Why? Because investors care more about whether its high valuation can be backed up by actual performance, like whether Blackwell chips sales has met the investors' expectation. So the tech sectors actually is under a lot of pressure based on the valuation. So the stock price already reflect sky high expectations. So there is less room for surprise, less room for future return. So let's look at Nasdaq. It is strong, but since mid-December, it starts to lose steam. Honestly, I think Nasdaq is overvalued and needs some time to cool off. Or maybe we will see a very big correction. If I were trade, I will wait until it falls below 20,700 and start to short it, and with a target around 90,800. So to further back my opinion, I want to show another chart. This chart showed that the top 7 tech giants now take up even larger parts of S&P 500, especially after Trump won the election. Meanwhile, sectors like financial, which reflect the broader economy, has been sliding. The gap between these two charts is getting wider, and it reminds me of last August Black Monday. Back then, we have seen a big gap followed by 3 weeks heavy selling after Japan hiked interest rate. And if we look for long-term trade, the Shiller PE ratio has hit 37.5. That is higher than it was being in 2021. And also back then, there is a huge correction, and Nasdaq has back then dropped 35%. And to make things worse, the 30 years Treasury yield, often used to value US stock, has also climbed past 4.9% and is getting closer to 5%. That is partly because of the expectation around Trump's tariff policy, and it is also pushing the dollar higher. And higher rates and a stronger dollar are not good for stock markets. So combine all of these, US stocks looks overvalued. If there is bad news happens, such as weaker economy data or a debt downgrade from Moody's, the market, especially the Nasdaq, could see a sharp drop. And on the other hand, if there is no bad news, the market may still fluctuating at this high level for a while the Nasdaq will lagging behind.
And Peter, what about the euro and the US dollar?
So let's start from what moves the US dollar. It is obviously the rising of the US Treasury yield. The yield has going up for two key reasons. The first is the US job data is getting better, especially starting from October. The second reason is that the Trump's tariff policy, people is thinking that if Trump getting into the office, and after the tariff policy has been in place, the long-term inflation of the United States will rising. And on the same time, his tariff threats against Europe and Canada has hurt the euro and Canada dollar, which also helped the US dollar to rise. However, there is also risks to make US dollar drop, like the falling Europe natural gas price will support euro and the UK pound. This is not good for US dollar. Also, the Friday's non-farm data may be critical. If the numbers are weak or the previous data is reversed further down, the dollar will also get some pressure. So for longer term, we think the Trump's tariff will support US dollar, but in short term, I still think the dollar will have some space to drop. So let's talk about the trading strategy. So for Eurodollar, the downward trend, I think, is still very strong. Last night, Trump's tariff news caused the pound to drop sharply and the UK bond yield spiked. However, if in short term, I think Euro USD still have a huge support in 1.025. I don't think in short term it will break through, only if the non-farm data is super great. So a better strategy, for my opinion, is to buy Eurodollar on the dip, on the level of 1.025. But if the Friday job data is weak, the pair could still climbing, breaking through 1.045 and possibly to hit 1.06 in the next month. So if you are looking to short Eurodollar, it is better to wait until Trump's policy are officially in place.
Okay, Peter Pan from ACY Securities, thanks for joining us. Now that does it for this episode of The Trade. Be sure to join us tomorrow.